John, I believe you're muted.
All right, can you hear me now, Davidson?
Yes.
Okay. Good morning, good afternoon. Thank you for joining us in Lewis Thomason's second weekly seminar for businesses navigating COVID-19. Today, we're going to spend 20 to 30 minutes on topic. We have one new panelist that I'm going to introduce to you. Again, the subjects we're going to overview are the current matters that we know about in the CARES Act, those things that we're monitoring, and those things we still don't know about. Let me introduce to you now first, Michael Good. Michael Good is another tax lawyer in addition to Katie Goodner. Michael Good has a Master's of Tax Law from New York University. And I think I mentioned to you before that Katie has a Master's in Tax Law from Boston University. In fact, we have 4 Masters of Tax attorneys at Lewis Thomason. It's nice to have this specialty. Well, what we're going to look at today, basically what we know right now, is that the House has passed the amendment to the CARES Act that deals with the payroll plan that was for a period of only 8 weeks, and that had some restrictions on utilization of the monies with regard to the amounts that could be spent non-payroll. As you know, the House, or you should know, because we did a follow-up email to you, the House bill provides for 24 weeks of utilization and 40% non-payroll payments being permitted and forgiven. The Senate is evaluating that. Senator Rubio, who heads up the Small Business and Entrepreneurial Committee, says he's going to vote for it, but there is some suggestion that the 24 weeks could be limited to 16 weeks. We all hope not, but that is something that is going to be discussed by Katie and by Davidson. The Senate is to act on that this week. And of course, once the Senate acts on it, the president will sign it, hopefully immediately, and it will be implemented. So we're still monitoring that, and that's what we're going to focus on today. What we still don't know is how that's going to turn out, and also what about the next phase of the COVID-19 Act. Senator McConnell has suggested that, and he's a majority leader, suggested that the next, we'll call it phase of legislation, will be the final phase. It should not affect the Main Street lending program, which is extremely important, that will affect many of you who will still need dollars in loans to tide you over for the next period of time. And so that guidance, which is out now, it's 56 pages worth of guidance, still is being examined by various banks. And we don't want to go into those details today because it's going to take a long time to analyze that. And I'll probably send out a deck on that before we speak. And Katie and I and Michael Good will principally speak on that subject probably 2 weeks from now, possibly next week, but more likely 2 weeks from now. And that will last, it'll be a lengthy webinar. Again, we don't have time to answer interactively questions, but last week, many of you sent in texts and emails, and we immediately answer those. So we'll ask you to do that again. Take a look at the decks that are presented, the slides that are presented. You'll see email addresses. You'll see ways to contact the panelists, and that's the best way to communicate with us. I'm going to turn it over to Katie next. Then it will be Michael Good. Davidson will finish up. And then after he finishes, that will end the seminar. And like I said, it's going to last probably another 20 to 25 minutes from now. So thanks again for joining us, and look forward to talking to you again next week. Davidson or Katie?
Thanks, John. I'm actually going to let Michael jump in and kind of take over, and I'll be speaking shortly after Michael once he finishes on some of these notice or the NOL carryback provisions of the CARES Act. So Michael, you're up.
Okay. Hello, everybody. Okay. Can everybody see me while I'm talking here? Am I showing up? Yes.
You are showing up.
Yep, you're good, Michael.
Okay. All right, great. All right, so one of the things to know about NOLs is, what are they? It's when a company's allowable deductions exceed their taxable income within a tax period. So why is that a big deal? Well, because how can you use a deduction if you don't have enough taxable income for it? So essentially then you need to be able to do something with that, either move it back or move it forward. Well, I'd like to step in my DeLorean and let's go back in time a little bit. Let's go back in time, not all that far, to when the Tax Cuts and Jobs Act was enacted. For that act, it got rid of something called the carryback. And what a carryback allows is, so again, you have these deductions, you can't use them. What are you going to do? Well, maybe you can carry them back. Maybe you can go back in time. Well, if you can go back in time, then that's great, because you could get an instant deduction for that. So so that can be a really powerful thing. Well, obviously, to balance off a lot of the benefits that people were getting in the Tax Cuts and Jobs Act, they had to cut out some of the benefits of that, and they got rid of these carrybacks. Instead, you were allowed to carry forward. And actually, historically, you were limited to carry forwards of 20 years. But the Tax Cuts and Jobs Act changed this so that now you can carry forward indefinitely. However, the CARES Act added back for a period of time for any net operating loss arising in a taxable year beginning after 12/31/2017 and before 1/1/2001, they can be carried back to each of the 5 taxable years preceding that. And what's and also you can take it. There's an 80% limitation that it also did away with. So now you can do it against 100% of your taxable income. So this is quite a powerful thing. But if you don't want to do the carryback, you do need to do an election, an irrevocable election to do that. So that's an important fact. But the problem, though, with the CARES Act is it did not provide additional time to file for these carrybacks. So the IRS did decide to grant a 6-month extension of time. So so in other words, then for this means that if a taxpayer had a loss in 2018, there's a form it needs to file by June 30th, this June 30th, not next year's, but this year's, in order to take advantage of the expedited carryback procedure. And you really want to be able to take advantage of this expedited carryback procedure. Because, you might be thinking, well, wait a minute, Mike, why do I need to do that? Why can't I just go ahead and amend the returns? I get, what, 3 years to do that? Why are you rushing me? Why do I have to do this now? The problem with amending a return is that when you amend a return, the IRS doesn't have any time period obligation to refund you. If you do the expedited process, you're going to just simply get your money quicker. And let's face it, I think anybody who's dealt with the IRS, I'm sure Katie can tell just the same story as I do. Not all the IRS offices are back yet. Not all the IRS offices are and because remember, they're in different localities, they're in many different places, and a lot of them are just simply not back yet because of various regulations and whatnot. So there can be quite a bit of of lag with getting anything done. So insofar as you can take advantage of an expedited process, then I really think that that's something that you should do, as opposed to relying on amending return. It's also way easier to do. So that's important. And then of course there's various upcoming deadlines for other tax years as well. And you know, one thing to say about this too is, if you're in the middle of mergers and acquisition deals and things like that, you know, there's been some discussion of this. You know, maybe your deal was coming about pre CARES Act. Well, now maybe, you know, some of these now operating losses could be used now with the carryback, and it's something that should be contemplated in any current mergers and acquisitions deal. Are there some NOLs that the money could be gotten right now? Don't forget that there's carry forward limitations if there's a change in ownership of greater than 50%. So you got to be careful of that too, especially again now you got this nice carryback thing. So it's just definitely something to take a look at in any of your mergers and acquisitions deals. There is some things though that there's concerns about businesses using this to manipulate taxable income, to you know, to different tax years when tax rates might have been different, and so you know there's some talk in Congress about limiting this or eliminating this or whatnot, but I don't know how likely any of that is, because there is, you know, taxpayers that have already taken advantage of this, and it doesn't seem like it's going to getting a lot of traction to completely do away with this in the Senate. But really, the main takeaway, because I'm not going to go into, you know, each separate form. What's the expedited form? How does that all work? You know, because that's going to exceed our time here. And the complexity, but really what you need to know is that this can be a way to get, if you have some net operating losses that maybe this can be something that can be used to get you some quick money. It's not a loan. It doesn't have all these other things. This could be some fast cash for you. You don't have to pay back. You don't have any employee requirements or anything else. So if you have this, you know, this is something to use, and you know, we're happy to help look at anything that anybody might have with this in terms of seeing what we can do. And again, in any mergers and acquisition deals, this is definitely something that should be contemplated if there are NOLs that are part of it. All right, I'm going to turn this back over to you, Katie, and thank you very much.
Thanks, Michael. The other two things that we're going to cover, that kind of what we know right now, briefly on the Main Street Lending Update Program. For those of you who are monitoring this program, and we're still waiting on a full rollout, some updated FAQs came out last Wednesday, our last webinar. And there were a few things that they clarified, and just want to touch on those briefly. The bulk of what was clarified was determining kind of U.S. operations for companies who are domestic and international. And there's a lot more information on this slide and the next one, looking at if the borrower, and you can go back, Tanya, to the first slide, but determining if a borrower has significant operations in the U.S. What the FAQs tell us is that that should be evaluated with subsidiaries, but not parent companies or sister companies. So you can go down, we're going to look at anybody under you for the borrower, but we're not going to go up, and we're not going to go out. And there are some examples listed here. Also, the FAQs helped kind of clarify what qualifies as created or organized in the United States or under the laws of the United States. And what it tells us is that they have to have been created and or organized in the U.S. under those laws and meet the significant operations requirements. So again, a lot of stuff that we already knew, but some further clarification there. And if you go to the next slide, Tanya, something that's important that was kind of assumed but not clarified is that proceeds from a Main Street Lending Program loan may not be used for foreign parents, affiliates, subsidiaries. It has to stay in country. It has to stay in the U.S. In the event the borrower is a subsidiary of a foreign company, we have to keep those funds here. It doesn't disqualify, but the funds have to stay here in the US or US business affiliates. A couple of other minor clarifications that came out. Looking at affiliated groups of companies, they can only participate in one Main Street Lending Program facility. Specifically, if you've got an affiliate that has previously participated or has an application that's pending in a Main Street facility, the business can only participate in that program by using the same facility that their affiliate is also using or has an application pending. And then finally, PE funds that are engaged primarily in investment or speculation, which or that they are, we know that PE funds are engaged primarily in investment or speculation. So we've been told previously they're ineligible for PPP loans. We also know that they are ineligible for Main Street Lending Program loans. However, their portfolio companies that would otherwise be eligible if they meet the criteria are able to participate in Main Street Lending Program loans. So that's kind of the brief update on Main Street Lending. Not a lot since last week. As John mentioned, we're monitoring this program closely in the 3 different facilities that the program will be administered through. And we'll probably have a specific update on this in the next week or 2 as we learn more. The last kind of update on what we know or what we've learned in the past week, and this is probably what most people are interested in at the moment because it's what you're hearing about and what affects most of our clients right now because they are PPP borrowers, is an update for the PPP Flexibility Act. We talked about this last week. The act was pending in the House, House Bill HR 7010, and it's currently before the Senate. It passed last Thursday, the 28th, in the House, and what it did, I'm going to run through the changes that are not, I want to be clear, this isn't law. This is what is proposed and has passed the House. So for now, we're still operating under the CARES Act and the guidance that's come out under that and the current loan forgiveness application. But if this moves forward, here's the changes that we have been given that are before the Senate at the moment. The first is that the covered period would be extended from 8 weeks to the earlier of 24 weeks or December 31st of this year. However, the borrower may choose, if the 8-week period works for you and you said, we got our loan in mid-April, we want to wrap this up in mid-June, that works for our operations, you may elect to continue using the 8-week period. That's what we have so far. A lot of questions that have come in have been, can we choose what 24-week period? Can we start, in August if we think our fall is going to be difficult and have 24 weeks run beginning August 1st? Or could we only do 15 of the 24 weeks? And the answer to that is no, not under the current proposal in the bill that's pending. Your options are either 24-week from the date of the loan funding for the covered period or the 8 weeks that was already there. If your loan doesn't fund until October, then that may run December 31st. But right now, that's the extension for the covered period or the alternative payroll covered period that we talked about last week. The second change affects qualified payroll expense threshold for loan forgiveness eligibility. As most of you know, it's been all over the news for the past month or so. There's this 75% threshold that if you meet 75% of your loan goes to qualified payroll expenses, then your loan qualifies for forgiveness. What the PPP Flexibility Act that passed in the House does is reduces that to 60%. There's been some debate about this reduction, and if there's something that may hold this up in the Senate, that's one of the items that's been identified. But for now, this is what we have from the House. The third thing that changes with the PPP Flexibility Act is your FTE reduction. It actually gives them even more latitude than the safe harbor that we got in the loan forgiveness application for inability to rehire an employee who refuses to come back to work. What the PPP Flexibility Act does is says, well, we're not going to apply a reduction to your loan forgiveness if you can't get your full-time employee count back up to the average that you had for the reference period. If one, you're unable to rehire the employee, which we talked about last week, but also two, if you're unable to hire a similarly qualified employee by December 31st of this year, or three, the borrower is able to show that the borrower was unable to return to a same level of business activity as prior to February 15th of 2020 due to sanitation, social distancing, or other safety requirements. And an example of that would be you have a large company that has a cafeteria and you have brought some workers back, but for health concerns, you can't get the PPE, you can't have food production safely, so you're not able to rehire those cafeteria workers. Lots of different examples there, but I've been getting a lot of questions about this third prong, and I think as long as there's a memo to your file, and what I've been advising clients is if this passes and this is how we operate, document everything. Document why we can't get back to similar levels, what our issues were in obtaining PPE sufficient to bring all the employees back, or if there are still government shutdown orders, things like that. If we go to the next slide, another thing that changes, and this is more minor, but for new PPP loans that are issued after the enactment of the Act, the term will be 5 years instead of 2. And what the current provisions say is that if borrowers and lenders of PPP loans that were issued previously want to amend the terms, they may also take advantage of a 5-year term, but that's going to be between borrowers and the lender that issued the loan or that did the underwriting. Borrowers who were previously prohibited from payroll tax deferral, touched on this briefly last week. The Social Security portion of the employer's payroll tax, that's 6.2%. Back in April, the IRS came out and said, you're not eligible to do that if you have a PPP loan. SBA FAQ came out and clarified and said, no, everyone can take advantage of the deferral, but if you got a PPP loan, that deferral is only as good as long as you're waiting to get a decision on your loan forgiveness, which is still a benefit, and it increased the number of people and borrowers who were able to take advantage of that payroll tax deferral that came in the CARES Act. What the new PPP Flexibility Act says is that we're going to make this available to everybody. Regardless of whether or not your PPP loan is forgiven, you're eligible to take advantage of the payroll tax deferral portion of the CARES Act. As John mentioned earlier, and I touched on briefly, the bill has bipartisan support in the Senate. We've not received any kind of indication as to when that vote might be. Senator McConnell mentioned on Monday that it would be soon, and we're kind of tracking because we have PPP loans that are going to have their 8-week period run in the next week or so. So our hope is that we'll get some kind of guidance coming quickly. As I mentioned a few minutes ago, it's really important to continue documenting all use of your PPP loan funds and continue operating under the current law, under the CARES Act and the guidance that we have from Treasury and the SBA, and the loan forgiveness application that was issued a couple of weeks ago. That's all we know to do at this point, and until we get something that is passed and signed, those are the parameters that we have to operate within. One thing that we have mentioned to multiple clients who have asked is, what if we submit our loan forgiveness application and something changes and there's now a longer period that would be more advantageous for us, or we did something that is now no longer in keeping with the new law. And right now, everything that we've seen that's changed has included safe harbor provisions along the way that say, if you did this previously, we're going to give you a window of time to resubmit an application, to withdraw an application, to make changes. So we're going to continue to monitor that. we'll keep watching the Senate and be on the lookout for an e-blast from our firm if something happens between now and next Wednesday's webinar. For now, I will turn it over to Davidson to kind of let you know more what we're monitoring and what we're still waiting to find out.
Thank you, Katie. I know we've kind of reached the end of our 20 minutes, so I'm going to be very brief with this. Currently, we are monitoring a few pieces of legislation. Clearly, the PPP Flexibility Act that Katie had just touched on is kind of at the forefront of what we're looking at right now. But we're also monitoring the HEROES Act, which is the new $3 trillion big stimulus plan that has passed in the House, but is facing some contention in the Senate. And this bill is mostly aimed towards employees and individuals rather than businesses, but there are many provisions that will affect businesses that people need to be aware of. For one, it will cap the net operating loss back to 2018, and it will allow for the deduction of qualifying expenses that were paid using forgiven PPP funds. Additionally, it will expand and change around the employee retention tax credits a bit and increase funding for the traditional SBA 7A loans. And along with the HEROES Act, we're also looking at the Small Business Expense Protection Act. This is a little bit of a quieter act. It hadn't got as many headlines, and it would also allow for the deduction of qualifying expenses if they were paid using forgiven funds under the PPP. And as far as these things are what we know, there's still several things that we don't know. And if you want to go to the next slide here, Tanya, I'm going to touch on just a few. We still have questions related to PPP forgiveness. As we've worked through these applications a bit, specific questions have arisen that we don't have answers to yet. And we don't really know when we will get answers or if we will get answers, or if some of these questions will be left up to the banks to decide when you submit the application. We also don't know the official launch date of the Main Street program. We've received a lot of guidance from the program recently, and it appears that the launch date is pretty imminent. But as of now, we don't know the exact date. And we're going to cover this in more detail in the next 2 weeks. And finally, measures might be coming down the pipe here. And so we just have to keep an eye out for anything new that comes up. And with that, we can wrap this webinar. We hope to see you all again next week here at the same time on Wednesday, and for some new topics, but also still covering what we know and what we're monitoring. And if you have any questions, please feel free to reach out to any of us. You should be able to see our emails and phone numbers here on this slide. And with that, I'd like to thank you all and have a great day.